Welcome back to New Zealand Property Insights. I'm Paul Roberts.
And I'm Debbie Roberts. We're the owners of Property Apprentice, and we're here to help you navigate the New Zealand property market with facts, not just headlines, because let's face it, the media has a massive negative bias. In other words, good news doesn't get the clicks. So we'll cut through the dramatic news bites and show you the positives to focus on.
Today, we're opening episode 14 by looking at what I'm calling the market of opportunity. While some headlines are focusing on a cooling market, making it sound like it's not a good time to buy, the real story in May 2026 is the incredible window that has opened up for all those ready to take a strategic step forward.
It's such an exciting time, especially for first-home buyers who are now snapping up over a quarter of the market. Plus, we're going to discuss why the current shift in investor sentiment is actually a healthy reset that levels the playing field for everyone.
We're also peering into the future of finance. We'll discuss how AI is acting as a superpower for mortgage advisors, taking the stress out of paperwork so you can focus on your property goals.
It's an episode about taking control, finding value, and embracing the tools of the future. So let's get into it. So first segment, we're looking at the strategic reset, finding value in a mature market. Starting with some more fascinating insights from Associate Professor Michael Ream, Senior Lecturer in Property at the University of Auckland Business School. At this point, he might start to think we're picking on him, but I'd say we're actually just offering another argument to consider.
Exactly. While some mom and dad investors are moving to the sideline, this is actually clearing the path for more considered buyers who aren't interested in bidding wars. The facts around this is he states that the historical trend of investors taking up 30 to 50% of the market is cooling, allowing for more balanced dynamic between different types of buyers. In major centers like Auckland and Wellington, he says the focus is shifting away from short-term capital gains towards long-term stability and yield. We would say that property investing has always been a long-term strategy. For anyone looking at short-term capital gains, it's a very risky game you're playing.
Debt to income limits or DTI restrictions are acting as a foundational anchor for the market, ensuring that lending remains tied to actual earnings and economic reality. Current DTI limits, set at 6 times for owner-occupiers and 7 times for investors, provide a stable framework for banks and homeowners alike to plan for the future.
Economists suggest that while house prices and incomes are finding a new alignment, this creates a much more predictable environment for those looking to build a multi-property portfolio. Emerging political signals suggest a long-term commitment to make sure housing is more accessible, which encourages a healthier, more diverse market.
So I find Michael Ream's analysis actually empowering for investors. He's essentially saying that the noise is leaving the market. When you aren't competing with thousands of people just buying on hope, you can actually sit down and negotiate a deal that makes sense for your bank account on day one. And it's a return to the fundamentals of investing. Like Paul said, it's not a set and forget thing. It's not just buy something and then hope for the best. The DTI limits can stop the market from overheating, which means your investment is potentially more protected from the wild swings of the past. It's about building wealth on solid ground rather than on a bubble.
And for those looking at Auckland or Wellington, don't let the stagnant headlines scare you. Stagnant often means fairly priced. If you're a strategic investor, this is your time to pick up quality stock without the pressure that we had back in 2021 with style auction rooms and FOMO everywhere. I don't think those times will be back, but it's so weird how people jump into the property market when everybody's doing it.
Yeah, we're like sheep in New Zealand. We follow the herd. But this market is the thinking person's market. We're helping our clients move away from the get rich quick mindset and more towards the get wealthy slowly but surely mindset.
Now, Ream said that if we wanted affordable house prices and incomes needed to be in alignment. He was quoted saying, in my view, DTI tools should be tapered down to a target that we would like. We would achieve affordability if we got down to 4 times instead of 6 and 7. He said politically that may never occur, but he was surprised by Housing Minister Chris Bishop's comment that house prices needed to be brought down. But Ream said That wouldn't happen overnight. And again, to quote him, that would be a huge shock to the housing market. But if there's advance notice and the banks know, and the players in the market know it, I think over a course of 5-10 years, it could all taper down. I just don't think there's a political will right now.
Yeah, so that's what he said. And it's an interesting perspective, isn't it? Here's our counter argument. If we want to improve housing affordability, even though it's already the most affordable it's been for over a decade, we need to increase supply, not regulations. In fact, the market's already proven this. With the increase in supply at a time that demand is lower, we've seen price corrections, price reductions. So it's already been proven, literally by every property cycle in history, not to mention basic economics, that prices are driven by supply and demand. However, it's also interesting to note that most economists would say that even with the recent increase in building consents, there's still a risk that we're not building enough dwellings to house future population growth.
And if you look at how much it costs even to buy land and then the cost to build, it's pretty hard to make it any cheaper than it is now. So the second segment, first home buyer takeover, we're looking at massive good news story. First home buyers have officially taken over a huge slice of the market, reaching levels we haven't seen in nearly 5 years. Now, when was the last time we heard that on the
Yeah,
news?
exactly.
Especially TVNZ.
Stop that. You're going to cause a fight. Fresh data from Totality shows that first home buyers bought nearly 25,000 properties over the past year. They accounted for over 27% of all sales in the first quarter of 2026. So let's have a look at the actual facts here. First home buyers are currently responsible, like I said, for more than a quarter of all the property sales in New Zealand. The median price paid by first home buyers has risen to $720,000 this year, up from $700,000. Yet buyers are reportedly getting more house for the same price.
Standalone house purchases now make up 77% of first home buyer activity, a significant increase from the 70% share that they have seen during the apartment heavy boom years. Smaller properties remain the sweet spot, with 1 and 2 bedroom homes seeing asking prices rise about 3.2% annually to roughly about $606,000.
The average age of a first home buyer has dropped to 35, though Aucklanders still tend to wait until they're 37. Obviously, prices being a little bit more expensive in Auckland. Westpac economists warn that OCR hikes could be coming as early as September this year, and fixed mortgage rates have already begun to move higher from their recent lows.
That 77% figure for standalone homes is the real winner here. It proves that first home buyers are still looking to get into homes rather than units or apartments.
It's a bang for buck moment. However, I am a bit concerned for some people about the timing of these OCR warnings.
Yeah. My advice, don't just budget for today's rate, stress test your numbers. If your mortgage goes up by $200 a week in 6 months, can you still afford to live?
This is literally the reason that we've always recommended to our clients that they work with a mortgage advisor so that they can get help with things like mortgage structure, interest rate refixes, and how to manage your mortgage effectively. Interest rates are still currently below the long-term average. And like we said in the previous episode, they're cheap at the moment. So make the most of it and don't fix for short term. Don't just go for the cheapest rates that are available, or you might find yourself having to refix at much higher ones. Talk to your mortgage advisor to help you to reduce the risk while we're navigating this rising interest rate environment. So third segment for this session, finally, we're looking at the AI mortgage revolution. So looking at how technology is changing the way that your mortgage advisor processes your loan application.
It's a shift from manual paperwork to AI native models. Experts are saying that in just a few years, an advisor won't just be filling out forms.
Rude. Mortgage advisors should be doing much more than just filling out the paperwork for you. If they aren't, you need to find yourself a better mortgage advisor. Seriously though, AI is going to be a huge help to mortgage advisors, enabling far greater efficiency, allowing them more time to spend time doing what they do best, which is using their knowledge and experience to help clients to get the best loan structure and manage that mortgage over the lifetime of the loan to help them to achieve their goals.
So some facts: AI tools are now being used to scan, extract, and summarize bank statements and financial documents in minutes or seconds. Tasks that previously took us humans, assistants, hours of manual works. 2/3 of New Zealand mortgage advisors are already using AI or plan to within the next 12 months to improve that efficiency in onboarding and workflows. AI native models use algorithms to reduce bias and show borrowers only to the lenders that are genuinely eligible for based on evidence-based data.
Despite the efficiency gains, AI currently has almost no role in the actual advice decision for most firms. Human judgment, advocacy, and accountability remain the core of the service. Challenges remain regarding AI hallucinations, data privacy, and the need for client consent when using AI tools like meeting note takers. Financial Advice New Zealand has launched a 12-week AI in Advice certificate to help advisors integrate these tools safely while maintaining compliance and trust.
I love the pilot metaphor. It suggests that advisors are still in control, but they have much more powerful engine under the hood. For a borrower, this could mean faster approvals, fewer errors, especially as AI will also be helping the loan assessors in the bank to process the applications at their end too.
It's definitely about improving efficiency, but we can't lose the human element. AI can summarize a bank statement, but it can also make stuff up. That's what's called the hallucinations. Remember our recent podcast about tenants using AI to write applications to Tenancy Tribunal, where AI told them they'd be able to claim like $30,000, whereas in reality, they were only eligible for a couple of $100.
Yeah, that's a good point. And Andre, October, mentioned that some clients actually using AI to fact check their advisors. That can be dangerous if the AI gives generic or inaccurate guidance. It reinforces why you need a human expert to audit the AI's output.
Exactly. Trust is the currency of advice. If an advisor uses AI to clear the paperwork so they can spend more time actually advising their client about strategy, then everyone wins.
When it comes to keeping your financial information protected, a good mortgage advisor will know how to balance AI efficiency with keeping that information private. So that wraps up episode 14 of New Zealand Property Insights, from the DTI silent leash to first home buyer surge and the AI revolution. The market is moving fast.
If you aren't already a lifetime client of ours, and if you want to learn more about the fundamentals of property investing, join me at our next free online event. It's called How to Succeed with Property Investing. The 100% free, and we focus purely on the education you need to make more informed decisions. You can find the link in our show notes or go to propertyapprentice.co.nz to register.
Thanks for joining us today. And remember, like and subscribe to our podcast so you don't miss an episode.
Thanks for listening. We'll see you next time. Hey there. Want to stay on top of the latest property news and trends? Subscribe to the Property Apprentice podcast for weekly updates that will help you to navigate the market like a pro. We cover everything from insider tips to expert interviews, so you'll always be in the know. And don't forget to ring the bell and hit that subscribe button here on our YouTube channel for even more helpful content to boost your property journey. Check out the link in the description to subscribe to the podcast, and we'll see you in the next episode. Happy investing.